Welcome to another video, and in this video we're going to be looking at the weekly macro themes. This is a report from a couple of weeks ago, and this is one that goes out to clients. Now we're going to be looking at topic 5 in this report, but this one was quite an interesting report really. There was this bit on China property, and a sort of alternative take on how you can look at the yield curve in relation to global equities, and a bit on UK equities and the New Zealand stock market. Pretty interesting one there actually, even though it is a very small market. So the one that I wanted to focus on here is this one, number 5, boring bears. So we'll start with the bottom line first of all. I'm seeing more bearish signals as cyclicals are stretched versus defensives, small cap stocks look vulnerable, and the VIX looks too low. Now, why did I call it the boring bears? Well, partly because, it's almost a sort of a kind of a, bit of a boy who cried wolf situation where you've got increasing number of signals that certainly on the face of it look bearish, or things that sort of remind you of a major market top, if not a short-term market top, and yet the market just keeps on going. So and as the market goes higher and higher, then it tends to push on a lot of those things and make them even more accentuated, such as valuations getting more expensive and VIX, staying low. So there's 3 different categories of boring bearish signals that we're going to be looking at here: the cyclicals versus defensive, small caps versus large, and also in and of themselves, and then the volatility aspect. So boring bears on the cyclicals versus defensive. So just a quick readout of what this says. So my cyclicals versus defensive analysis shows cyclicals looking stretched on a relative basis, and both in absolute and relative terms on price to book valuation metrics. What's also concerning is how the spread of earnings revisions ratios for cyclicals versus defensives has turned down. So let's go through that. First one here shows that price to book ratio averaged across 3 sectors on the defensive and cyclical side. Cyclicals is basic materials, industrials, technology. Defensives, telecoms, utilities, healthcare. And you can see here that the black line, the cyclicals price to book ratio, is at truly exceptional levels. We last saw this kind of level prior to the .com, well, pretty much at the .com peak and just prior to the financial crisis. So it's certainly something to pay attention to. We also saw it on a smaller scale, but the same kind of run up in the lead up to the 87 crash. Now, when you look at valuations, it's when they run up like that, that peak there, they can collapse on and on themselves, but typically when you have just high valuations in and of themselves, it's usually not enough, and you need to see some sort of catalyst or something that's acting to sort of trigger it. And this chart here, the one on the right, is certainly one that kind of fits that bill. It shows the earnings revisions ratio for cyclicals versus defensives. So cyclicals minus defensives in terms of the earning revision ratio. And that's the earnings revision ratio, if you're not familiar with that, shows the proportion of upward revisions to downward revisions, basically. And you can see here that it has diverged away from the relative performance line. So that black line is the relative performance of cyclicals versus defensives. If it's going up, cyclicals are outperforming. If it's going down, defensives are outperforming. And so, you can see there that in the past, those two have lined up reasonably well. There has been, periods where they have diverged. But I would say that's a warning sign. I mean, where it would truly become an even more important warning sign would be when it goes all the way through to the other side. But lining these two up, at the risk of sounding like a boring bear, it looks pretty bearish. So on to the next one, the small caps. It's actually just small caps. I think I said small caps versus large, but we do have the large cap one there just for a bit of context. So this is using the S&P 600 small cap index, and you can see there this is the PE10 ratio. That one thing that's kind of interesting is how it just sort of seems to trend up over time, but also how it is at fairly high levels recently, and certainly much higher levels than where the large caps are trading at. So it's pretty fair to say that the small caps are trading at fairly rich valuations, certainly going off that chart alone. And then the one on the right here, it's kind of similar to the previous set of charts actually. So it shows in the black line the Russell 2000 year-on-year change in forward earnings. So this is really where their earnings are basically on an improving path or contracting path on a year-on-year basis. And it's shown against the ECRI leading economic indicator. That's a weekly leading index with a 7-month lead here showing it with that. And just as that indicator helped to pick the rebound in earnings, it's also potentially flagging and sort of lining up with that current slowdown there too. So that could be, if that continues to go all the way through, and that's pretty widely available, so you can keep track of that. I guess looking at the past can be useful here. So when it did come all the way down then, I mean it at least showed you that the momentum, it gave you a lead on the momentum. And when it went all the way over to the negative side in, I believe that's 2012, didn't quite get a contraction in earnings, but it certainly had a slowdown. So I would say it has sort of average reliability as a leading indicator, but certainly at the moment, if it as a minimum, it's saying that the momentum of earnings going forward is probably on the low side. And the final set of boring bear charts are on the VIX or volatility side of things. So 2 charts here. First of all, might just quickly talk about that one on the right hand side. So that's my alternative view on volatility, and what it's showing you is the rolling 12-month count of daily percent changes exceeding either plus or minus 1%. So basically, any day that had a move greater than 1%, it gets counted. And the count is at very low levels. It's at a 22-year low, and it's not far from getting to some of those all-time lows seen in the 60s. And there's a couple of observations from this chart. When you see these periods of extreme low volatility, they don't tend to last, terribly long, and when you get a reversion or a tick back up in that, most of the time it's leading into a market correction, like we saw, in that 2015-2016 period, or more of a substantial bear market as in the 2008 kind of period. But there can be times when volatility will turn up in a more erratic bull or euphoric sort of crazier bull market, like into the final stages of the dot-com boom there. That indicator started to heat up, and that's pretty much in line with the kind of conditions that we saw in that market, which were not so much a fear of loss as 2008 was, but fear of missing out when there's these substantial gains to be had. So that's probably quite an interesting and useful piece of background context. And then when you look at the VIX itself, what I've got here is we've got 1, 2, 3, 4, 5 different models that have been tracking here. So these are sort of, I guess, fundamental models for the VIX, things that tend to line up with it or explain it. And they are shown in their sort of regressed form. So, basically what level is of the VIX is implied by these indicators. And if you look at the spectrum of them here, so you've got high yield credit, policy uncertainty, realized volatility, jobless claims, the PMI. So you've got a mix of economic indicators, market indicators, and sort of background risk level or noise level indicators in the policy uncertainty there. Bottom line, VIX is currently lower than all 5 of those models. So that's that whole quote unquote too low aspect for the VIX, and it can stay too low for certain periods. Those mid 2000s period there showed how it can stay low for an extended period of time. And by the same token, that alternative volatility indicator did stay kind of low for quite a while, in that mid 2000s and in the mid 90s there as well. So that I guess that would be the caveat of it. But volatility, whether it's implied volatility or realized, it's extremely low and kind of looks too low. And those are the 6 boring bearish charts. If you've got any comments on those, any questions, or if you want to put in your own take, please go ahead and put that into the comments section on the YouTube video, and definitely be keen to hear from you. And other than that, go ahead and subscribe to the channel if you like this video, and because we'll be doing more of these in the weeks to come.